In 1907, this man, pictured here with a knife, locked John D. Rockefeller, Treasury Secretary George B. Cartlew, the wealthy banker Lord Rothschild, and chairman of Citibank James Stillman in a room and demanded they give him $100 million of their own money. And they did. This is the story of why. As economies grew and finance became more important to that growth, many countries adopted a central bank. Remember, initially every bank issued their own currency on the deposits customers made with them. As certain banks grew in size, some countries simply gave one of them a monopoly over that process and some regulatory powers to help manage the financial markets. In Britain, for example, the Bank of England was given control of the pound, their currency, making them the only ones allowed to issue new money. They also tasked the Bank of England with ensuring stability in the banking system by managing the credit markets with sound rules and regulations. With a central bank at the helm, financial bubbles that pop and cause a panic could be managed so that they didn't spread throughout the whole financial sector by ensuring continued access to credit. The U.S. flirted with the idea of a central bank and had very limited versions of one in our early years and after the Civil War, but not like others. But that would eventually change. Financial panics started to become more and more common as industrialization enriched the formerly poor. In the mid-1830s, America was on the rise and expanding westward at a rapid pace. But a bad harvest in wheat in 1836 left many families without food or income. President Andrew Jackson also issued an order that all sales of federal land, which were considerable at the time, had to be made in gold or silver, not with the paper money issued by banks. Without new deposits and seeing higher withdrawals of gold and silver, banks increased their interest rates to attract more savings, but ended up popping a price bubble for cotton that further devastated farmers. Banks are usually able to handle the ups and downs like this, but every few years the disruptions would form a sort of perfect storm. Banks offer a valuable service in taking deposits and lending them out, then sharing the profits of the loan with their depositors. At the time, banks took in deposits of gold, and there were a lot of lucrative opportunities for lending for land purchases and cotton projects. But unpredictable economic turbulence led a lot of these investments to fail, while at the same time, hard times led many to withdraw their savings. But the banks they were withdrawing from didn't have enough gold to meet those demands because so much of it was lent out. This creates a panic where people hear that the bank they trusted to keep their savings was at risk of collapsing. Even if just a small fraction of their loans had defaulted, no one wants to be the person left holding the empty bag. And so they rush to the troubled banks, demanding their deposits back. Banks try to call back the loans they made, but for some, it just isn't enough, and they end up closing their doors. In the aftermath of the Panic of 1837, the U.S. lost half of its banks to bankruptcy, and with them, many people lost their entire life savings. A bank run occurs when a bank experiences an extraordinarily large volume of withdrawals, driven by a concern that the bank will run out of liquid assets, or cash. The problem is that banks don't have enough cash in their reserves, the deposits they keep on hand, to cover withdrawals, because they've used that money to make loans. Those loans are assets for a bank, money that will be paid back with interest, and so they can help a bank stay afloat. Normally when banks get into short-term trouble and they don't have enough money to meet withdrawals, they borrow from other banks to make up the difference based on the value of these assets. At the time they borrowed through clearinghouses, which were made up of a group of banks who would lend reserves to each other when one was in need. But in major panics like 1837, no one was willing to lend to each other, and the whole system freezes up. When bad luck would concentrate on a particular industry, it would often lead to financial panic. In fact, you could often predict them as they would happen cyclically with the farming season. The whole financial system just wasn't set up to deal with shortfalls fast enough. In the past, these panics would diminish the fortunes of the rich, but would rarely result in a significant or long-lasting downturn in the whole economy. But after the Great Enrichment, everyone was rich enough to be impacted. And since sustained economic growth depends on credit to finance it, financial panics threaten that prosperity. After the Panic of 1837, production fell for 7 years before recovering, leading to higher unemployment. The panics weren't just getting more frequent, they were getting worse. Outside of a small group of historians and economic historians, the Long Depression has mostly been forgotten. But the nation went through over 20 years of economic turmoil, experiencing a sequence of recessions that kept unemployment high, left multiple generations of people to scorn banks, and weakened economic growth. Disasters like the Great Chicago Fire in 1871 and the Great Boston Fire in 1872 were a negative shock to the economy, which compounded with the burst of a speculative bubble in railroad companies. In 1873, the U.S. also abandoned silver as a form of money, moving to a strict gold standard. The downturn was severe, and the recovery very slow, as many labor unions turned to fruitless strikes. Central to the persistent problems were monetary disturbances. The complete dependence on gold left the U.S. vulnerable to international pressures, which attracted gold from the U.S. to other countries. Prices in the economy remained depressed, which also kept wages down and discontent high. The hot-button political issue of those decades of economic recession was bimetallism, which was pushed by a political movement called Free Silver. They wanted to monetize silver again, helping people in debt, especially farmers, by allowing them to repay their loans with either gold or silver. The debtor would be able to repay with whichever currency was more inflationary, reducing the burden of their loan at the expense of the lender. And while the heated political disagreements that I'm sure ruined many of Thanksgiving dinners have been forgotten, the cultural impact is still here. The leader of the Free Silver movement was a politician named William Jennings Bryan. He was the Democratic nominee for president 3 times, losing each time, which frustrated the movement's supporters. One of them was L. Frank Baum, who wrote the political polemic into a children's story called The Wizard of Oz. In the original story, Dorothy had to travel the yellow brick road, representing the gold standard, wearing silver slippers. They changed them to ruby slippers for the movie because silver was too overtly political. Dorothy was the innocent Americans. Scarecrow represented the brainless farmers. Tin Man represented a frozen industry. And the Cowardly Lion represented William Jennings Bryan, who lacked the courage to do what was needed to be done to win. The Industrial Revolution, brought on by a new culture of growth, made us rich. But with those riches came the problems of rich people. The web of credit meant that instability in the financial sector would spill over into every other sector of the economy. And with more borrowing and lending needed for the economy to grow, the crises became more frequent and more devastating. By 1907, people had had enough. So when Otto Heinz attempted a shady maneuver to manipulate the stock price of United Copper and failed so spectacularly that he took down the Knickerbocker Trust Company, one of the biggest and most respected financial houses on Wall Street, the rich and powerful were spurred to action. John Pierpont Morgan, known around town as JP, was the most powerful and respected banker perhaps in the world. He dispatched his man, Benjamin Strong, to Knickerbocker to assess the damage. After concluding it was hopeless for them, Strong was sent to the other big financial firms to determine what the fallout would be. When one big bank went down like this, people would panic, and a run on banks would start, spreading the financial contagion to otherwise healthy banks. Morgan identified the critical stopping points, where an influx of cash would be able to prevent the dominoes from falling by satisfying depositors. Morgan assembled the top bankers along with the U.S. Treasury Secretary and got them all to throw into a fund they would use to save the financial industry from another collapse. They used the money to infuse everyone else with cash, and the panic stopped. People were not as worried that they would lose their money after seeing someone like J.P. Morgan so willing to risk so much of his own. The U.S. still endured a deep recession, though without the high level of bank failures and credit crises, and everyone had finally agreed on one thing. It was time to solve this problem for good. As the political cartoons at the time show, people were worried about leaving the saving of our entire economy up to the whims and wills of the super rich. Senator Nelson Aldrich got the Congress to pass a minor reform bill, which did almost nothing. But it did establish a commission to study the monetary system and banking reform. And Aldrich himself chaired a subcommittee which was to study the possibility of establishing a central bank. And that's exactly what they would do.